Earnings were broadly in line with expectations, and that was delivery of around EPS growth negative of around 11%. What was interesting within that mix is resources were expected to be weak, which they were on the back of lower commodity prices, but industrial companies also as a whole delivered a negative 1% outcome on earnings, and that took the market a little bit by surprise. In terms of revenue growth and cost out opportunities, revenue growth is still modest. That's a theme that we've been seeing now for the last couple of reporting seasons, but also cost out opportunities seem to be exhausted. And so what we are seeing is margins starting to become compressed, especially with industrial companies. On the resource front, resource companies actually took out more cost than the market expected, and that was a little bit positive for margins, but also continuing increasing of production and firmer spot prices as we are sitting here today was a little bit of a benefit for the resource companies. Also reporting season, just broadly, sectors that actually delivered very strong results across the board. General retail delivered strong results. Building materials and casino companies delivered strong results versus expectations. Sectors where there was disappointment, insurance in particular, banks mixed results, and also telcos. A few standout results. Treasury Wine Group delivered a very strong result to expectations and very strong cash flow, really continuing the operational turnaround of the business and also showing the acquisition of Diageo starting to add to underlying earnings. Market took the result very positively. Also, management guidance around margins was stronger than the market expected for the outer years and really citing the tight luxury wine market, and that's where Treasury Wine have the opportunity to increase their profitability. So that was a really strong result. Other companies that we thought delivered strong results, BlueScope Steel delivered a very, very strong result on the back of stronger steel spreads in East Asia and cost out opportunities at Port Kembla being realised earlier than expectations, and also a strong building market really supported that result, and it allowed the company to pay down debt very, very quickly in the period. Other strong results in general retail, Harvey Norman, JB Hi-Fi, Nick Scali as a group delivered strong results, really driven by the strength in the housing market and people going out and shopping for whether it's white goods, electrical goods, sofas. Really, that was a real driver. Harvey Norman delivered revenue growth over the year of up 10%. And also improvement in profitability across all operating segments. Well, I mentioned about the weakness in insurance, and IAG, Suncorp, QBE as a group highlighted weakness, especially in the commercial insurance market and increasing claims costs, and that hit profitability across the board in that industry. And also one other interesting piece, and something that the companies all called out, was New South Wales CTP, where we started to see increasing incidence of claims and increasing claim costs also hurt profitability. And what you're starting to see is all those insurers starting to put through premium rate rises. So when you get your CTP, if you're in New South Wales, you'll see that the premium that you're expected to pay is a lot higher than it was last year. And what they're trying to do is basically claw back some of those losses. Other results, CSL delivered a result that was in line, but really guidance was below expectations, and really on the back of their newly acquired flu business, where the market expected it to break even this financial year coming. That's been pushed out by a year, and that's really hurt market expectations. But also, when you look at the expected EPS for CSL this year, it's the same as it was in 2014. So they haven't really been able to grow earnings. What we have seen is a huge re-rating in the multiple that people were willing to pay for CSL. And that really disappointed the market, and that was reflected in the stock after the result. Well, look, on the face of it, if you look at the forward multiple of the market at 16 times, it's pretty full, expensive relative to history. What we would say to that is interest rates are at all-time lows, especially around the world, but also in Australia. So that's quite supportive of the current valuation. We don't expect a re-rating in the market, given earnings growth expectations are only 7% for next year. But if we started to see a re-acceleration in that earnings growth, there is cause for the market to rally. In particular, within the market, we think there are some sectors that, relative to their current earnings growth profile and their multiples relative to history, are very, very expensive. So in particular, healthcare sector, infrastructure and REITs are very, very expensive relative to history and relative to their outlook for earnings. Well, we talked about Woolies before. We think Woolies is in a multi-year turnaround. We've seen a lot of change at the board level, at the management level. We're starting to see the first signs of a turnaround or green shoots in terms of better sales numbers. We feel that all the foundation is in place for a turnaround to happen at Woolworths. It's now about the execution. There are a lot of operational things that Woolworths can do within their own control to improve the profitability of the business. Also, the new KPIs that have been introduced for the 100 top executives, we think will drive the right behaviours in allowing the business to turn around. So previously, the only guide or KPI for management was EPS growth, and that has really led to bad behaviours. Now there is also a KPI around sales per square metre and returns on fund employed, and we think they are the right metrics to actually measure success of the business moving forward. Look, it is starting to play out, and I think part of the reason why it's happening is there is a realisation that interest rates can't go any lower. And you know, if we are going to look through an economic cycle, we all agree that interest rates, yes, they're unusually low, can't stay here forever. So people are looking at the spot interest rates and valuing some of these companies, and we think you need to take a through the cycle approach, and that yields you a different result when you look at the valuations. If you look at property trusts in particular, they're all trading at 30 to 50% above their NTAs. They're extreme valuations. If you look something like a Transurban, highly geared vehicles, had all the tailwinds of low interest rates, but not pricing in any prospect of interest rates ever being any higher. Transurban is geared at 8 times debt to EBITDA and delivers you roughly a 4% distribution. Is that enough for the financial leverage within that vehicle? We don't think that's enough, and that's why we're a bit vocal on them. Yeah, there's a lot of companies that will benefit. A steepening yield curve is good for banks in particular, so they should benefit over time. I think when you look at banks in particular in Australia, they look cheap relative on a relative multiple, relative to their historical multiple and relative to where they are trading versus the market today. I think what you have to be cautious about is where we are in the cycle for banks. And if I really look at it, interest rates all-time lows, bad and doubtful debt charges all-time lows. Now, that's probably not sustainable, and a housing market that we would all agree is at all-time highs or close to. So these are some of the considerations. We're cautious on the banks because we're starting to see pressure on their net interest margins. We think bad and doubtful debt charges cannot get any lower but can go higher over time. We're also seeing declining non-fee income as well. So there are a lot of headwinds in front of the banks. The market expects there to be just a benign outcome on the banks, and we're not saying that might not be the case, but we're being cautious because if it's not the case, there is a lot more downside. And even though they look cheap relative today, just the way things are set up, I think it pays to be cautious.